Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today we'll go through our regular market update. Earnings is pretty much winding down. So we'll do a quick look at that, and then Joe has some analysis that he'll be running through. So let's get started. So overall indices, same place, SPX in one, Russell in seven, IndexX also in one. High wise, you can see, excuse me, not too big of an increase here. 67 to about 70. But we have had some good transitions from 7 to 5, and I'll go through that in the market pulse. Otherwise sectors, pretty bullish, other than oil's been kind of lagging. And then I think one other kind of big thing, we watched the 10-year. That's dropped quite a bit, which has helped this bullish run. We're down about 4.3. You remember we were almost at 5, a few weeks ago. So it's a big drop, which has helped the market so far. Okay, excuse me. So market pulse. So we talked about this, last week, the cross. So we did get the cross. So, if state ones can hold above state eights, it's obviously very bullish overall for the market. So that's something I would be watching. Along with that, talk about, and let me just pull these out. So this is sevens here, and then so you see the fives. We're getting a build up. So it means these sevens are transitioning to 5. That's another bullish sign overall. So just kind of see if those continue, and then the 5s start moving to 1s. Obviously very bullish, but I think the key here is just to make kind of monitor the 1s to 8s, staying above the 8s for the 1s is very important, very bullish. So a lot of the over the past couple of years, a lot of the tops I showed you guys last week were Windows transition. That one flipped over on top of the 8s. So you can see here, once like here, once we get above those 8s, you get pretty good runs as far as the market. So that's the kind of big thing I'd be looking at, the 1s and 8s, and then 7s moving to 5. As far as new highs, new lows, not much going on really at all. We had those a lot of those spikes back here in October has pretty much just been almost straight up since the end of October. So we'll have to look at the key levels. We're getting right near it. And obviously across above here would be bullish too, but I think the key is this 1.8. Let's see, bullish, bearish. Now we're getting pretty elevated overall. We're at 70. I think Joe did when we get over 80 in the past, as far as bullish, but 70 to 80 is pretty high overall. A lot of you can go back and look, obviously, and the charts. I don't specifically have ones that I kind of call out. Joe has good analysis on this, but the ones I kind of look at is when state ones get above 45. So we haven't been there in a long time, but I'll kind of leave that with Joe. But obviously, bullish wise, we are elevated. So, and the longer we're up here, the better. Bullish overall. So, all right, so let's take a look at SPX. So the big number here is going to be this right here, 460707. So that's the previous high. That's the top end of our range, 4600. So if you look at kind of back here, kind of looking similar overall, kind of chart kind of, barely moving. Had a big day here where it popped above and just complete reversal, try it again to get above 46, and then that was it. So, we're getting up in that neighborhood. I think, we are up today, 466. So that's kind of what I'd be looking at. Obviously above 4,600, we have resistance in this target 1, 2 range, that 46, 75 kind of area. So, but I think we had to get through that 46 first. And, right now that support's pretty much right at 4,500, for this entry price here. So get support here, obviously down below, 44. And this is the range here on this chart, 46 to 42. So, we'll see if we can break through that level. Obviously, this is, I think, the most important thing, if we make moves higher, is watching that level, getting above there and closing above there, holding above there. Obviously, that's going to be um, very bullish for the market overall. So, kind of acting like it's running into a little resistance here. I'll show you the Russell kind of similar on the 1800 level, but still got a lot of time left for this stable one, and it's been acting pretty close to how it should act. So it'd be nice to see it run up to 46, see what happens there. That could be the resistance range here, pull back and possibly break through, but depend on how the market, how things go out there. So this chart's a little, let me pull this up here. So this is our 46. So what is, let me get the lower end here. The 42, that's the range. So, this kind of behavior is kind of similar here, kind of looking similar as it gets up here. Obviously, like I said, 46 going to be important, very important level to break through. If it fails, obviously we're going to be back in this range. But we'll see if we can get through there. But I'd be watching that close to the upside. Obviously above, the 50-day, the 200. So those signs are bullish. It's just a matter of getting through this level. That's kind of the key I see here. Okay, let's look at Russell. So Russell's having problems here. Always has problems. All right. Yeah, until we get the false breakout, right? So entry price, obviously, having problems with that. That's right at 1800. Go figure. Because like the range here is 19 to 17, but this is also, as I showed in previous charts, that 1800 is fairly important level of like resistance and support as we get through it. So acting like pretty decent resistance here. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 over 2 weeks. Kind of batting up against that. So that's another one you can watch. Getting above. All right, there's still people joining. Getting above 18, obviously going to be bullish. And then if this, stays above, you can see here 1809. I think we got higher than that, but it's we're at 1813 right now, so right above there. Which is, we definitely made new highs for this state 7. So I just kind of pulled back a little bit, but this kind of obviously a good level to stay above. Like I said, in those previous charts, previous weeks, you get above this 18, then you can make that run in 19. Obviously, that's going to be strong resistance. But it's kind of where we're at here. Obviously, 9 days into 11, so almost full move. Hasn't made the move up though, so it's kind of like a flat state 7. No. All right, let's pull up the chart here. So we did pop above that 50-day, so we're in between the 200 and the 50 right now. Getting them. So as of today, we'd be pretty much got up to that 1820 and kind of pulled back today's move. So that's something we can watch. Back here, showed good support, couple, about a week there, a little more support here, and finally broke down. Even back here, some support on the 200. So, I wouldn't say it's like a super critical level, but it's something worth watching, to see if it does um, act as resistance for here. So it looked like it did today. So far, we popped. Let me see how high we got. 1827. So we popped right above it, and now we're below there. So at least first take here, it's acting like resistance. So kind of this 18 I think is important. If we pull out further, our 3 tops here, especially in here, that 18 was real strong resistance, even back here a little, then finally broke through. 19 was resistance, and then false breakout number 3, all with the lower highs, and all retested 17. So where this is the third iteration of this. So even back here, 18 was kind of a problem. Popped up, got below, kind of choppy. 19 failed, back below 18, then another fail, finally broke through. So these are obviously, very important levels, all 3 of them, I think. And our range is 19 to 17. I'll just annotate that real quick. That's the lines. Hey, what happened? There we go. I don't know what happened there. Then the 19. So that's what I'd be watching here. So SPX watching that 46. If we move higher here, just getting above. I think that 200 would be a nice sign. Staying above that 200-day moving average here. Um, see if we can make that run up to 19. If we make the run here to 19, then obviously I think the 4600 could break for SPX. But we're kind of on resistance lines here, and just have to. The market pulse is showing bullish, elevated on the pie, but we're getting good transition 7 to 5. But just see if we can break through these kind of little resistance levels, and if not, if we don't, then I'd expect some more chop here, a little back and forth, and sometimes here it took quite a while to get over that 1800, so we could see repeats of that, obviously, but those are kind of the critical levels I see here with the Russell. All right. So I think the biggest thing has been the drop in the 10-year. It's really helped markets, and expectations have dropped quite a bit. I think they're now factoring in a cut, their first cut around March. So, but this has been a big drop from basically 5% all the way down to 4.2, below 4.3. So this is obviously, if this continues, this is definitely a tailwind for the markets, if these rates come down further. So always watch that, that 10-year. So let's see what else. As far as Fed, so I pulled this up. We'll go to this. I'm going to walk this out. There has been some changes here. So nothing really overall for the 2 weeks from now. Nothing expected hike wise. Pretty much there's nothing hike wise really factored in again, for the foreseeable future. This is 92% for nothing in January. And then you get into March, it's almost like a coin toss whether you get a cut or not. May, you definitely have a quarter point cut, 50% there. Then if you go like all the way up to next year, so for a year from now, the median is a 1.25% cut by next December. So that's been a big change. You can see here, about a month ago, we were at, 4.5, and now kind of like that median 30 is at 4%. So it's dropped 50 basis points over a month, expectations. So, so that's a big change overall, and the market likes lower rates. It also likes quantitative easing, which we are not doing. So this is, if these rates continue dropping, as expected here, that'll be good for the market. But this QT, the tightening, that's still a headwind for the market. They're pulling liquidity out. We showed a lot of those charts with like the money supply M2 dropping. So, if that correlation holds up, this correlation holds up, we would expect cuts at this point, in the next, 9 months, a year. We'd expect some serious cuts. Especially if we get the CPI, if it correlates, where it goes negative. At that point, there'll be quite a lot of cuts. But we'll see if that correlation holds up. It has been tracking. We've been tracking this for about a year now, and it has pretty much come down like it's supposed to. So, but this continues. Not a big drop off week over week, but the trend continues. So, obviously back here we had that banking crisis. We've had a few other banks fail, but nothing, no kind of watershed type event or anything, where they're going to have to pump yet. But, obviously that could happen. And we talk a lot about the bank's balance sheets being in trouble. Obviously those over the last few weeks, as the rates have dropped, their positions, their unrealized losses have, decreased quite a bit. If you're trying to sell, a 30-year, that was 3%. A couple of weeks ago when those rates were like 4.8 or 5%, but now they're 4.25. So those losses have dropped a lot for those like long-term holdings. So. Yeah, but I think the big, I was thinking about this, like one real interesting thing going forward, if they do start cutting rates and the Fed isn't, obviously they're letting a lot of stuff run off the balance sheet, with the amount of debt we're putting out there, I think it's like 1.25 trillion. Yeah, just they may run into a whole supply demand. We're putting so much supply out there that the rates may have to come back up. It's going to be an interesting how they how this whole all plays out. Especially if they continue the QT. So I didn't have any full charts, but pull that one up. So I think that was it. Market update. I'll open up to questions, comments. Feel free to unmute and fire away. There it
Okay,
is.
I'll throw one out there. Is it's like it was pretty neutral for until the next they said quarterly update mid-September when there's quad witching and everything toward the end of there'll be a harvesting of your losses and that sort of thing coming up next. But I don't see a whole lot of slight melt up, I would guess, until there's any new news. The market wants to go higher when there's no new news. So
Right.
I would
See,
suggest we're going to hang around
seasonality's in our favor right now too. I mean, this market's done pretty much like held to seasonality this year, I would think, pretty closely.
Yep,
So,
I agree.
end of the year is usually, good for the markets.
Retail news was up over the shopping holidays here, which have been, I think, shopping holidays all the way since the 4th of July. We've had shopping holidays, but I think I heard a lot of the financing of the recent retail buys have been buy now and pay later kind of thing. So we'll see how that works out for paying later.
Yeah, well, we know that credit card debt. I don't know where that one is, but yeah, there it is. Saving versus credit cards. Um, That's our collective credit card debt, just making new highs every week, I'm guessing. Yeah, I think you're right. Yeah, and this is a scary chart. Yeah. Yeah, I agree, Dave. Thanks. Anyone else? Questions, comments? Yeah, we got up to like 9 trillion, almost down to 775. So we're at 7.8. Decent runoff. See how long this can last. All right, I'll just pull up the earnings real quick. Not much left in earnings, so yeah, we got 2 weeks or so to the next earnings plan. I haven't decided. It might be the 20th because we're usually trying to get it around the 15th, but yeah, nothing starts too early there. So it'll either be 13th or the 20th. We'll roll out the new plan. But we've covered everything. The only active ones are the bearish runners, which are one of our dragging position overall. It's down about 1,000 overall. So 5 open trades. We got 12 closed. Can't see the bottom. 1, 2, 3, 4. So 8 and 4. So that's not terrible, but we had a couple big ones like this. Intel really ran. Yeah, let's see with this XPO. This bad. Those were the pretty much the biggest drag on the positions there. So other than that, it's been pretty average outside of those two. But this is definitely our only, our loser for the quarter so far. The other trades have, most of them, eked out. I think non-mover was good overall. Yeah, that's up like $2,000. So it's not going to be it hasn't been a banner earnings, but it kind of squeaked out some profits in a pretty turbulent quarter for the market, I would say. Um, any anyone have questions or comments on that?
My results have been the same.
Yeah,
Not great, but profitable.
it's better to not take a loss always. So thanks, Adair. Okay, well, that's all I had. Joe, you ready?
Sure, Josh.
Okay, I'll hand it over to you.
All righty, good job. Thank you, everybody. Let's see. Grab these charts. There's new UI, as Josh pointed out. The pie is just shy of 70. The sectors are pretty much all bullish. Just a question of which bullish state. So you're kind of picking up on your question a couple of weeks ago, with regards to the pie. I want to go back to the pie. I'll pull up some different charts, but just want to take a peek at TLT first. Stage 7, as Josh said, we've gone from 5 to below 4.3 today. Stage 7, a little over average days. It'll be interesting to see what the next state is here. It's had a pretty good run, whether we go from 7 to 5 or something different. But then back to the pies, and I'll give you some different stats, which we have talked about a little bit before. Below 15%. And we got there a couple times, as we've talked about. Early October, so about a month ago, and then I think it was October 27th. We get down to like 14.97. So 4 days this year we've been below 15%. Over the course of the database, on our, it's a little over 4% of the days, the pie's been below 15%. And so basically the database has just over 4,250 days in it. It's 181 days of the 4,256 have been below 15. 55 of those 181 days were in 2008. Okay, and we obviously all remember 2008. Number of years there were no days below 15%. But if you take out those 55 days going back to 2008, that's generally no more than 3% of the time that the pie is below 15%. So, quite extreme. I guess I'm not sure exactly, between October 4th and 6th, I think we got down to the 12, 13%. It's very rare that we get into single digits. We did it in 2020. We did it, in 2020. Remarkably, we got down to about 3% green on the pie. And literally, that was, March, April of 2020, post-COVID. End of 2018, when the Fed, they had that tightening spook, we got down to single digits and got to 8. We got there in 2008, 2009, 2011, single digits. So that's obviously even more rare than, below 15%, but still below 15% is very rare. About a little over 4% of the time if you take all 16 years of the database. Let me pull up I got SPX, Russell, NDX, and Russell. So here is the I think 1-year chart. What do we got? Okay, so I'm pulling this from the low in 2022, same day, for all 3 indexes. And basically we you know, we got in 2022, there were 3 periods, you know, so I'm just trying to focus a little bit on recent history. 3 times in 22, we got below 15%. It was the May period here, it was the June period here, and the ultimate low in October. Point here being, in each instance, you know, we got a tradable rally out of that level, you know, magnitude being different. But there's SPX, there's NDX, there's the May period, got a little bit of a bounce. There was the June period, you got a big bounce into that August high, you know, mid-August high, and then the ultimate low, you know, in October. Tradable rally, and as Josh said, you know, Russell, you know, believe it or not, you still got, you know, you got first time below 15, you got a tradable rally. You then, you know, had the same thing happen in June, below 15%, up into that mid-August rally, and then ultimately the low in October. So, you know, just on top of, you know, a shook states, I think, you know, keeping track of the extremes, you know, in the pie is pretty darn important. And so, just taking a look at those same 3 indexes again, over the past year, you know, we know kind of this time last year, we had the big bottom. There's SPX, but do focus now, you know, on the last time, you know, we got to below 15 in the pie. Here's first time, you know, it was October 4th through 6th, got a little bit of a rally, and then a sell-off. So, and then we come out of that sell-off with a launch. And that's the other thing, if we go back a year ago on SPX, you know, it was in the, I think this is September 30th. Yes, it was. You know, it was a couple days. It was this period in here. We're below 15, looking for, you know, on the upside now, big green bars, you know, I think can build some confidence that you have a trading rally. Now, you know, again, last year was October 13th, you know, so you get the whipsaws, but overall, it's not necessarily, it's, you know, hopefully we're not all trying to just buy lows and sell highs. You know, you can have confidence that, you know, these levels are tradable lows. And, you know, coming out of the more recent below 15 levels, you know, it was here to start, got a couple, you know, nice green candles. And then, you know, coming out of October 27, you know, just a monster rally. And, you know, we go from, you know, 2-4, you know, in the States to start maybe to step up with the 3 and then 1. And, you know, maybe we're going to have some legs on this thing. So that's SPX. Here we are again, a year ago. You know, we bottomed, you know, right in here, had a tradable rally, you can see. So, you know, it was the pie, you know, that basically foreshadowed going into a bullish state 7. And that's typically the case. The pie tends to lead, which, you know, as I look at this a little bit more, is kind of interesting. We have not, by the way, had this conversation with Ashok yet. So whether he will integrate, you know, some of the pie calculations with, you know, state modeling, it'll be interesting to get his take on that. NDX, you know, same thing. You know, just this below 15 turned out to be a real catalyst. And, you know, when I go back and I look at history in the various years where, you know, you get the below 15s, you get the above 80 and 85s on the flip side, you know, it's generally there's a story around these levels, you know, and that being the extreme. So, you know, we all do our homework. We got lots of different things that we take into account. Just suggesting that, you know, the pie may be pretty important, you know, from an extreme standpoint, you know, as we go forward with our different, you know, bullish and bearish trading. NDX, you know, kind of, let me just spread this out a little bit. NDX banging up on 16. So, we have, gotten through this, the July 19 levels, just barely, of course. We just got a state one, got a long way to go in terms of timing. So, it sure seems like we're going to go back and test these, old highs. And, if what they're talking about earnings that we've been hearing about for a long, long time, the drought in earnings is behind us. We're talking potentially high single or low double-digit earning increases in the fourth quarter. Why not a fairly substantial run here? That's NDX, and then just last chart would be, the Russell certainly tends to lag a bit, but those big green candles coming out of the low below 15%, I would think is not insignificant. So on the flip side, where are we going in terms of the database? And again, we're about 4,250 days in the database. Number of days or percentages above 80%. I know, Josh often talks about, 70, then the different levels of state 1 versus 8, in relation to the overall pie. But as we kind of anticipate, where the markets may go, again, so we all use, different things, distances above moving averages for, ended rallies or distances below. And in terms of numbers with regards to the pie, above 80%, generally you're talking about 6.5% of the time, the pie's above 80%. If we, do a symmetrical analysis at 85%, it is actually more than half of, more than twice as rare as it is for the pie to be below 15%. In terms of being north of, again, 80%, it's a little over 6%. Above 85%, it's just over 1%. So are we going to get there? It's hard to say. My guess is I think we will. I think we're certainly going to get over 80. I think this rally is going to have legs. Whether we get to 85, let me check my numbers here. The last time the pie got to over 85% was, 2020. Okay, so it's pretty rare. Let me just double check that. Yeah, 15 days in 2020, we got above 85%. Let me correct myself. There were 6 days in 2021 where we got, above 85% as well. Early in 2021, January and February, there were a few days. So it happened 15 days. Again, I'm talking about above 85%. 0 days, in the bear market of 2022. 6 days in 2021, early January and mid-February. 15 days in 2020, above 85%, coming out of, the launch of the COVID lows, you got as high as 92% in June of 2020, and you were about 85% at the end of the year in 2020. But again, something to anticipate. Prior to 2020, last time the database got above 40 or 85% was the year 2012. So we went 8 years without that happening. So, just wanted to offer a little historical perspective on the pie itself. Sudhir, you brought this into being, and I think there's a lot of magic in the extremes, of the pie. So A little bit of a look back below 15 and, the all important look ahead above 80 and 85. Again, above 80%, it happens about 6.5% of the time. Below 85, it's just over 1%. So
Is there, Joe, is the level of the pie is not, you can't put that into a back test, can you?
I don't know how we do that, honestly. I think, when we're able to get, more of a Shook's attention, it's something, it'll just be interesting to see how he would like to handle it. Josh, any thoughts on actually being able to put it into a back test?
Yeah, we had talked about it. It wasn't done properly, so but we have the capability to do that. But
it's not in any of the parameters right now, if I understand correctly, that can be put into a back test.
no. We had asked for it, but it wasn't working properly, so he'd have to fix it.
Yeah, okay.
But it's we can do it.
I think my experience, just anecdotally, because I track the level of the pie in an Excel file every single day, the extremes are valuable and the trend is valuable. It's if the pie is declining, consistently, that's a good signal. And if it's rising consistent, like right now, it's rising. So I think those are the trend and the extremes are very interesting.
You have mentioned that in the past for sure, Sudhir, and thanks for mentioning it again, because that's I gotta go in and do some homework on that. In terms of length of the days in the trend and things of that magnitude. So thank you.
Yeah, and if you I realize you guys got a lot on your plate, but it would be interesting to put those parameters in a back test. One of the things we've discussed over the years is that there's never been a really good back test that shows bearish trades.
Mm-hmm.
And I would think if you've got a pie up above 80 and it starts to reverse, that might be conditions that would lend itself to more successful bearish trades. And
at least a covered call, right?
Yeah, well, I'm talking bear call spreads or stuff like that, But
sure.
There's not, like you said, that parameter can't be put into a back test yet. I think you guys got some excellent data. So
one thing we're going to do before long, and we're pretty close with the homepage. Well, with this platform. But we are going to add a number right here next to Market Pulse, and that number will be somewhere in the neighborhood of 4,500. It'll tell you how many issues are being tracked, that day in the database. Because obviously, when I talk about these percentages and extremes going back to the beginning, we had far fewer numbers in the database. So, it's important, obviously, just to keep that in mind.
Yeah, interesting.
We also we're hoping to launch our new website. When we talk about dates and things like that, but we got our fingers crossed we may be able to launch it by the end of next week. So, am I crazy for mentioning that, Josh?
No.
So
Fantastic.
we'll see. It's we've obviously been working on all this stuff behind the scenes for a while. It's a slower process than we'd like, but hopefully by next Friday we'll have a new website. Any questions, comments?
Yeah, this is Lee.
Hey, Lee.
Hey, I like what you were talking about, and I was wondering if there's any way to show it graphically, just like you do let's say SPX, where you're showing the date, and the SPX, it shows the level at it goes up to or goes down to. Could you do the same thing with the pie showing what percent it is, whether it's over 80, over 85, or down below 5? Do you know what I'm saying?
How are you suggesting, or are you suggesting, as part of the charts, or what? I'm
Yeah,
not quite sure.
like what's on the screen
Mhm.
right now, and I don't know, is that
Right.
SPX or
Yeah,
okay?
it's SPX.
So from left to right, you've got the dates. Starts at November 1 and goes till the 5th of September, roughly. Okay. And over on the right, you've got the 4,700, 4,750,
Yep.
4,500, 42. You see what I'm saying? Over here. Oh, you can't see mine.
Yes. Over here.
Yeah. Yes, exactly. Well, could those be the percents?
So this chart, our charting package comes from a group by the name of High Charts. What I'm thinking, Lee, as you talk about this, maybe, when, we agree to what an extreme is. I think sometimes, we got to be careful how noisy we make, the charts, even our homepage. But maybe when we get to an extreme above, 80, or we decide what the level is. Maybe, like the state label, we add that somewhere, down below or up above. Just to alert us to the extreme.
Joe, I'm talking about a chart like this that is only showing the market pulse percent for.
Oh, I got you. Okay.
So you're not showing
By
anything
itself.
else.
Yes. Yep.
Okay.
Gotcha. Yep.
I don't know if that makes sense, but I like what you're talking about. And when you talk about visualizing, and then Sudhir says, well, trend matters. Well, I can see the trend here, and I can see the extremes over time. I don't know. Anyway.
Yeah, no, we, thank you for the thought, Lee. I realize, I'm sitting here talking for 5 or 10 minutes and just throwing around a bunch of numbers, hopefully, without anything, graphically supporting it. So, Josh and I can talk about that, and that could be a possibility, because if you couple that with, maybe the chart itself, or, yeah, we'll talk about it in-house and see if we can come up with something.
All right. Thanks.
Yep.
This is Dave. I got a comment and a question for the group, kind of. So one thing about the pies are kind of like 1s and 8s, and all the 1s and 8s, 7s, and all of the, all of the states are in there. But okay, do we, when you're thinking about a specific trade, you got to trade something. You're going to trade. There's no trade for the 8s or the 1s or the 7s or there's the trade for an ETF, or there's a trade for an individual stock, right? So I think maybe what I was thinking Lee was leaning toward is a pie for the specific group of stocks. And not all of the 1s and 8s, but like SPX pie, or Q pie, or Russell pie kind of thing. So my question for the group was, okay, we've talked where the indexes are, where they're going, the forces behind the index, each of the major indexes, and how we got to where we are, and what factors or forces are impacting where that's going. We can all make sort of a inference on where all the stocks within these separate indexes might be going. But are guys in the groups, or gals in our group, are we trading? I tend to trade individual stocks more than the indices, or even the ETFs within the indices. And I don't know whether that's prevalent, or whether everybody trades as their own trading style, but I don't necessarily trade the indexes by themselves all that much, but the stocks within there, I think, tend to move better trades than the index trades. Does any comments on that? If people think it's easier to trade the indexes versus the stocks within the indexes, or ETFs within the indices, or not? Um, any replies on that? I mean, right now the implied volatility for all the indices is low. You know, I think the SPX was like at 13, so there's a lot of uh, uh, people are complacent. I think the trading group, the trading universe is a little complacent right now, which kind of follows the nothing said, no new news, and the stock prices tend to float up a little bit. But individually, I'm kind of curious as to whether people are trading groups, indices, or individual stocks. Just curious to what people are doing. Any comments from people that are trading?
Yeah, I'll answer. In general, if the market is rising and the green pie is rising, it's a lot more efficient, in my opinion, to trade the ETFs for the indices, DIA, SPY, than it is to try and find individual stocks or sector ETFs, because the market just kind of goes up as a group. And on the other hand, if the market is going sideways and the pie is bouncing around, then it's rotating between groups. Then you kind of have to find stocks or industry ETFs. And then if the indices are going down, they usually go down as a group, and pie is declining. Once again, it's easier just to trade the 3 or 4 inverse ETFs. Does that make sense?
Yeah, okay, I see where you're going, Sudhir.
It's just fewer trades. It's just fewer positions.
True, but you have it's like if you're bullish, and let's say we're at the bottom of the range and we're bullish now, like it was at the beginning of November, because we just had a sell off in October. The October, Josh, I think hit it right on the head. Seasonality is holding very, very well this year. So there's, that was the time for people to be just buying, buying pretty much anything at the time. But for the Qs, for example, there's I think a better trade. If you're bullish on the Qs, you're going to make a better trade being bullish on the few stocks in the Qs that are driving the Qs rather than all the Qs. If you follow that thought, that's my reply to that. It's like, I see what you're saying, Sudhir, but in some cases, I think the index trade is muted by just because the fact that it has everybody in there and not the best of the best or the worst of the worst kind of thing. Just my thoughts.
You can use the leverage ETFs.
Yeah, but I hear what you're saying there too. But the leverage ETFs really are one-day trades, in my opinion. And if you look at the prospectus on any of them, you'll see that's what they say. They say if you're holding longer than a day or so, you're really that's not the way they intended the 2x and 3x ETFs to trade. They're very short.
That's what they say in the prospectus, but the reality is you can hold those for a lot longer when they're
you can do anything. But have you been doing that? I mean, have you been holding for a substantial months and doing well with that? That's an interesting observation. So thanks for that.
Yeah, I do the same. I do either the leverage ETFs or futures. A future on the micro future on the NASDAQ, I think it's goes up $2 for every point of NASDAQ. So, I mean, you're essentially a 2x ETF is what it is. So the micro on the S&P is a 5, goes up $5 for every point. So, you know, I think the thing with the leveraged ETFs is that they want to put a disclaimer that over, let's say, a month, if it's the 3x ETF, you won't get exactly 3x, which is fine. If you get 2.6,
Right.
right, you're still better than buying the single ETF. So generally, you know, it amounts to how much work you want to do. Yeah, if the Qs are going up, you can go in, dig in, and try and find the 2 or 3 of the 100 stocks in the Qs. I think there's 100 that are causing it to go up, and just go after those stocks. But in my mind, you know, it's just a lot easier just to buy the Qs or the leveraged ETFs, or even the. This is what I did in the last rally: is I had the micro Q futures, I have the Dow and the S&P. I didn't have the rest. I just bought futures because they all went up together. So it's just not time efficient to go try and find the individual stocks for me. It might be for other people.
Okay. Okay. But are you, by the way, follow on question there, are you trading, are you just actively trading the leveraged ETFs, or are you using options to trade the leveraged ETFs?
That question was for who?
Anybody that's trading the leveraged ETFs. I mean, are you just buying and then selling, you know, getting in and getting out altogether of you know, the amount there, or are you, you know, pinning an expiration date on your trade?
I buy the leveraged ETFs direct. I don't buy options on them. That's my.
Yeah, I've been doing the same thing, Dave.
Okay, thanks. That's what I kind of figured you were doing, but
Yeah.
Thanks for the clarification.
Yeah, the spreads on those leveraged get pretty massive sometimes. Not easy to execute in those.
Well, thanks,
Hey,
guys.
Joe, Dan here. Question.
Yeah, Dan.
That was an interesting study that you did on the history and the percentages. You don't have a PDF or notes or anything on what you were talking about today, do you?
I have bits and pieces, not in one piece. I'll try to get that done before next week's meeting, and you know, we can post that.
Okay, beautiful. Appreciate it. Thank you.
You're welcome.
That's very interesting today. I like that.
Well, thanks. Ashok gives us a hell of a lot to work with. Hey, Dave, before we go, talking about individual stocks just for a sec. You know, I saw a headline, MU upgraded their forecast. I know you're in this space quite a bit. And any comments about, you know, the headline I saw today?
Was that directed to me, Joe?
That was to Dave.
Okay, sorry, Joe. I had my thing muted there. Which stock in particular were you talking about?
Micron?
Oh, Micron.
You know,
Micron.
you trade that.
Yeah, I've been following the news there because I watched the news on that. But yesterday it was down quite a bit because they actually came out and did an update on their revenue and then their cost projections. So they upped the revenue a little bit, but they were a little bit they pulled back on a little bit more on their forward guidance a little bit. That was yesterday. So today it was kind of a bounce back. It's like, okay, the news is sort of evaporating. So they figured the sell-off yesterday was a little bit more than normal. And the news that's affecting most of the semiconductors that affects them differently are are the big headliners and whether or not they can sell to China. If you can, if you're prohibited from selling to China, even if you're the leading supplier or chip maker or does chip designer or whatever, if you can't sell to China and they've been a big part of your revenue, then you know, your stock has got headwinds. But if you don't need to sell to China, for example, today NetApp was network appliance NetApp was up quite a bit because it doesn't sell to China or as much to China. It's not in China's not in focus. Like AMD can't sell to China. NVIDIA can't sell now to China as much. So those stocks that were, you know, maybe really good stocks and a good cyclicality, time to buy them. If you there's the China headwind is still in your face for the cutting edge companies. For the cutting edge companies. So I don't know. Did I answer your question on Micron? I think
Yeah, a little bit,
was,
but yeah, you did. Thank you. I mean, I know you spend a lot of time in that area. I think it's an important area in terms of potential leadership in the market. The headline, I just saw a quick headline, you know, and I thought, I had no idea what happened yesterday. I thought that they had talked about increasing their guidance, and I thought that might have been meaningful, but you know, that big gorilla in the room is China for sure. But anyway, I just wanted to see if you thought it was significantly meaningful, you know, what they may have talked about today. So thank you.
yeah, I
I
expected
saw a
actually
headline this
Micron.
week. I saw a headline this week where it said that the the chip companies were selling to China anyway. I don't know if anybody else saw that.
Yeah, NVIDIA says that they try to work around the sales to China, and sooner or later, I don't know, I think they're going to get plugged for that by the SEC or the administration. But we'll see. I mean, that's kind of where it's at. The memory guys I'm surprised that memory sellers have not been doing better because of all the AI flaps. So, you know, if memory is not selling off the shelf or off the wall, I'm not seeing a big pickup in AI applications firing up in data centers and whatever. My comments there. It's a lagging thing. A lot of hype, and the lag to fulfill the hype is going to take a while.
Yep. Okay. Well, thank you, Dave. Anybody else, or Josh, back to you?
Okay, yeah, we'll wrap it up. So do it again next week. Thank you all.
Thank you.
Thanks,
Thank
everybody.
you.
Guys.